Hello everyone, this is Ben Cat. Today we are going to talk about the recent bank failures in the US. On March 9th, Silvergate Bank, a relatively small bank in the US, announced its closure. The next day, Silicon Valley Bank, the 16th largest bank in the US, also closed its doors due to insolvency, becoming the second largest bank failure in US history. 2 days later, on the weekend, Signature Bank, the 20th largest bank in the US, also announced its closure, becoming the third largest bank failure in the country. The stocks of small and medium-sized banks in the US have generally plummeted by 20% to 80%, and over 20 bank stocks have been suspended from trading. All of this happened in just 1 week. Some people may think that these bank failures are not a big deal since they are not as well known as JPMorgan Chase or other major banks. After all, there are over 1,000 banks in the US. However, the key issue here is the size of these banks. Although there have been over 140 bank failures each year in 2009 and 2010, the total assets of these failed banks combined were less than that of just Silicon Valley Bank or Signature Bank. This year, only 2 banks failed, but their size is much larger than the failed banks during the 2009 to 2010 period. The impact of these failures is significant. In just 1 week, the number of bank failures is approaching the peak of the 2008 financial crisis. The largest bank failure during the crisis was Washington Mutual Bank, with $307 billion in assets. The current situation is alarming, especially considering that it has only been 1 week. Alright, now that we understand the severity of the situation, let Ben Cat give you a good rundown. Silicon Valley Bank, SVB, was founded in 1983 and went public on NASDAQ in 1988. As you can tell by the name, SVB serves primarily startup companies, especially those in Silicon Valley, with various deposit and loan services. Some big banks tend to avoid these high-risk startups, but SVB successfully captured this market and grew with the Silicon Valley ecosystem. According to its Q4 2022 financial report, SVB serves nearly half of all technology and life science startups in the US. While the bank has almost 9,000 employees, it has fewer than 20 physical branches because it doesn't deal with individual retail customers. So, even many Americans may not have heard of this bank before its collapse. However, its stock price grew over 700 times from 1988 to the end of 2022, with an average annual return of over 20% when converted to logarithmic coordinates. Before its collapse, it had been named Forbes' best bank in America for 5 consecutive years. Forbes sure seems to have a knack for predicting these things. Then came the pandemic in 2020, and the Federal Reserve cut interest rates and printed money, followed by a massive $5 trillion stimulus from the US government. The whole market was buoyed by the US dollar's surge in liquidity, and that money naturally flowed to high-risk, high-yield places like Silicon Valley startups, and therefore, to SVB's customers. So, in just 2 years from 2020 to 2021, SVB's deposits grew threefold, from over $60 billion to nearly $190 billion. It was like happiness came too suddenly and left people a bit bewildered. Here's the key point. At this point, SVB made a foolish move that triggered the entire collapse. It began to aggressively buy long-term fixed-income bonds with nearly 2/3 of the $130 billion in new deposits it received over the past 2 years. SVB's rationale was that it needed to invest the money to generate profits since the funds were not its own. Banks typically make money by either lending or investing, and with such a sudden influx of deposits, it couldn't lend out all the funds immediately. Therefore, investing the funds became a priority. The problem was that SVB's investment options were limited. After the 2008 financial crisis, the US government imposed strict regulations on the banking industry, and banks couldn't use depositors' funds to invest in risky assets like stocks. Instead, they had to invest in liquid assets with low default risk, such as government bonds or high-quality corporate bonds, to prevent runs on the bank. As a result, SVB chose to buy a large amount of long-term bonds because their yields were generally higher than short-term bonds. However, in 2020, interest rates were at historic lows due to the Federal Reserve's rate cuts. The 2-year Treasury bond rate was below 0.2%, and the 30-year bond rate was only 1.5%. SVB bought long-term bonds to chase higher yields, but in doing so, it exposed itself to significant interest rate risk. The longer the bond's maturity, the higher the risk. The interest rate risk of a long-term bond is commonly measured by its duration, which was high in SVB's case. For example, if interest rates rise by 1%, the price of a 30-year bond could drop by 10% to 20%. Therefore, SVB took on significant risk to chase a 1.5% yield, and the bank eventually suffered massive losses. Let's take a closer look at how SVB's textbook-style losses unfolded. Using the example of the 10-year Treasury bond yield in the United States, we know that bond prices and interest rates are negatively correlated. So, if you want to buy long-term bonds, their yield will be approximately as such. Let's use this to simulate the trend of Silicon Valley Bank's purchases of long-term bonds. To better understand when it started buying, let's also add its deposit amount. As we can see, when the US lowered interest rates in 2020, bond prices soared, and Silicon Valley Bank received a large influx of deposits. It started buying, and by early 2022, liquidity had tightened, and deposits had dwindled. The Federal Reserve began raising interest rates, and bonds experienced their largest decline in a decade. More than half of Silicon Valley Bank's depositors, who had invested over $100 billion, began losing money. As you can see, it all came together, and this decline was not wasted. Actually, at first, Silicon Valley Bank didn't want to hold so many long-term bonds. This bond became long on its own. Curious? Let's expand on this topic with some technical details. If you can't keep up, feel free to skip it. Within its $117 billion bond investment, 14% is in Treasury bonds, and the primary 68% is invested in RMBS and CMBS. MBS stands for mortgage-backed security, which has a feature called negative convexity. Specifically, its risk increases with increasing interest rates. This means that the more the Federal Reserve raises interest rates, the longer its duration becomes, and the riskier it becomes. This also means that losses become more severe. At the end of 2021, Silicon Valley Bank's average duration was only 4.1 years, but a year later, it had become 6.2 years. This meant that the risk of its investment portfolio increased by 50% as the Federal Reserve raised interest rates. The risk of this investment portfolio stretched out like noodles, all thanks to the Federal Reserve's interest rate increases. As the risk increased, so did the losses. You might think that Silicon Valley Bank would hedge against this risk, but it did not cut its losses. After all, it had gotten through the previous 30 years in the same way. However, the problem is that the Federal Reserve had not raised interest rates so drastically in the previous 30 years. In the end, in 2022, Silicon Valley Bank lost $15 billion in just 1 year due to a simple investment decision-making error. You should know that in the past 30 years, it only earned about $10 billion in total. In just 1 year, it lost everything due to a simple investment decision-making mistake. Okay, let me explain why there was such a large loss and why people might not have known about it. It's about the bank's investment in bonds. If you want to hold the bond until maturity, it will be classified in a category called held to maturity on your investment account. This way, when the financial statements are prepared, they don't have to calculate the gains and losses caused by market fluctuations because it will converge to the face value when it matures. So as long as I put these investments in this held to maturity account, the market won't know how much I've lost. Silicon Valley Bank had more than 3/4 of its investments, over $90 billion, in this account. The market didn't pay much attention to it. So if you estimated it like we did earlier, you would have known earlier and could have shorted it to make a fortune. Now, Silicon Valley Bank has lost $15 billion, which is already very miserable, but it accounts for less than 10% of its total savings, and what you want to buy is bonds, so the loss is temporary. As long as there are depositors continuously pouring money into it, it is actually possible to pass this wave of losses. But unfortunately, in 2022, there was a liquidity crunch, and at the end of the year, the largest tech companies laid off tens of thousands of employees, making it even more difficult for startups to hold on. Financing began to decline rapidly, and they had to continue to withdraw money from Silicon Valley Bank. In 2022, Silicon Valley Bank's savings declined from $200 billion to $175 billion. That's when trouble began, right? Originally, I wanted to put this wave of losses in that held to maturity account to let it pass undetected. But now, if depositors start withdrawing their money, it's going to be a problem. Do you see how the market is plummeting now? Silicon Valley Bank definitely doesn't want to sell those bonds because floating losses will turn into real losses. So, it went crazy trying to borrow about $30 billion from the Federal Home Loan Bank, FHLB, to fill the gap, which barely got them through 2022. However, just as they made it through, they played another big stinky move. They thought to themselves, I can't keep borrowing forever, these interest rates are too high, savings keep flowing out, and investments aren't improving. I need a permanent solution. So, on Wednesday, March 8th, they announced they would sell $21 billion in bonds, resulting in a total loss of $1.8 billion. But that's not all. They also announced the issuance of new shares and preferred stocks to raise $2.25 billion in funds. This move, to put it politely, is foolish. Essentially, they're banging the drum, telling the market, look at me. I'm Silicon Valley Bank, and I'm losing money on investments. Everyone should withdraw their investments. I have to sell assets and need more money. Please give me some money. Can you imagine how the market reacted? On March 9th, Silicon Valley Bank stock immediately plummeted over 60%. Moody's rating agency downgraded them to junk status on the same day, and the stock was subsequently halted. By then, raising funds was impossible for the bank, and the Silicon Valley entrepreneurs were very close-knit and kept each other informed. Peter Thiel, a number of other big shots, and many VC firms in Silicon Valley urged their startup companies to withdraw their money from Silicon Valley Bank. In just one day, $42 billion was attempted to be withdrawn from the bank. Imagine $42 billion in one day. That's a quarter of the bank's deposits. This was a classic, textbook bank run. Thus, what started as a relatively small financing event caused Silicon Valley Bank, a bank with 40 years of history, the 16th largest bank in the US, and Forbes' best bank in America, to collapse in just 48 hours, taken over by the government's FDIC. I'm sure Silicon Valley Bank didn't think too much about it when they were devising the financing plan, but they didn't anticipate that the market would be a scared bird that couldn't withstand any jolts. This is somewhat similar to the LTCM incident of the past, although that was even more spectacular. As we mentioned at the beginning, in the 2 days before Silicon Valley Bank collapsed, Silvergate Bank also went under. This bank was much smaller than Silicon Valley Bank, with only about $10 billion in deposits, which is about 1/10 of Silicon Valley Bank's size. Its collapse was even simpler because its clients were mainly cryptocurrency companies and exchanges. In 2022, when the cryptocurrency market was struggling and FTX experienced a scandal, people began withdrawing their funds from these cryptocurrency exchanges and companies, and these companies in turn withdrew their funds from Silvergate Bank. As a result, its interest-free deposits plummeted from $13.2 billion to $3.9 billion. Like Silicon Valley Bank, Silvergate Bank also had to sell off many of its bond investments, losing nearly $1 billion. Why did these two banks collapse in the same week? I couldn't find a direct reason, but it's possible that they were both preparing their annual reports but couldn't complete them, so they had to report their own failures. Of course, it could also be purely coincidental. I don't know what you think, but the result was that these two banks suddenly collapsed, causing the market to panic. People were afraid that other banks might have problems, especially smaller banks with concentrated customers. Bank stocks collectively fell, and more than 20 bank stocks were suspended from trading in the market. Any company related to these two banks was affected, and even the stablecoin USDC temporarily became uncoupled from the US dollar due to its connection to Silicon Valley Bank. From now on, the nature of this whole situation has changed. It used to be about a single bank with problems, but now it has evolved into a market panic. Think about the headlines in major media outlets all day long, talking about bank failures, crisis, and the recurrence of the 2008 financial crisis. Even Ben Katz's viewers can't wait to hear about this. If you had money in a similar small bank in the United States, would you be panicking? Even if some media experts come out and say that Silicon Valley Bank is just an exception and that other banks have no problems, can you really relax? Shouldn't you withdraw your money, deposit it in a big bank, or even buy some Bitcoin? Look at how Bitcoin has surged these past few days. I estimate that those big banks, although their stock prices have fallen slightly, probably haven't stopped attracting new deposits these past few days, and are secretly happy about it. Of course, this is just my speculation and may not be accurate. Regardless of whether the collapse of just one or two banks is an exception, it has already evolved into a credit crisis, specifically a credit crisis for small and medium-sized banks. So even if I don't have any data right now, I can imagine that those small and medium-sized banks, or local banks in California, or banks related to cryptocurrencies, may be experiencing a very serious run on their deposits. And one of them is Signature Bank, the 20th largest bank in the United States, which has many cryptocurrency customers. It experienced a run on its deposits on Friday, March 10th, with around $20 billion, or 20% of its deposits, being withdrawn in one day. It was declared bankrupt on March 12th and taken over by the government agency FDIC, becoming the first casualty of this credit crisis and the third largest bank collapse in U.S. history. So when faced with a run on their deposits, these small and medium-sized banks generally have only two options: either find a big bank to take over, or ask the government to take over. Under normal circumstances, the bank, including the government, would prefer to find a big bank to take over. I believe that over that weekend, Silicon Valley Bank was definitely frantically lobbying various big banks to negotiate and sell itself first. For example, its UK division was successfully sold to HSBC. Can you guess for how much? £1. However, in this situation where the situation is unclear, as of the time of my recording, no major bank in the US is willing to take over SVB US. Okay, so the next question is, what about banks like Silicon Valley Bank and Signature Bank in this situation? What should be done when depositors may suffer huge losses without knowing what is happening? Do you think the government should intervene? The government's goal at this time is certainly to prevent this credit crisis and not to let the market panic. At the same time, it does not want to give these small banks a wrong signal that they can lose money, and the government will back them up. So what does it do at this time? In fact, in reality, there is a relatively ideal situation, and the government has actually done so, which is to guarantee the money of depositors, but the shareholders of this bank are done. This not only gives depositors confidence but also does not allow other small banks to inflate. On March 12, FDIC announced that from March 13, all depositors of Silicon Valley Bank can withdraw their deposits in full. It has set up a bridge bank specifically to ensure that these depositors can withdraw their money, and it will cover it first. Then, it will sell the assets of this bank in the future, because bank assets are more liquid and of better quality, and it is not that difficult to sell them, unlike houses. But if it is still not enough, then let the bank system find it. On March 13, Biden also came out and said that everyone's deposits are safe, and he will do everything he can to protect everyone's deposits, and this will not cost taxpayers money to stabilize the market. The government just wants to tell the market not to panic, and you don't need to run on the bank. I will back you up. Okay, we've basically finished talking about this matter. Let's analyze the reason for the collapse of Silicon Valley Bank. First of all, its risk control is certainly a big problem. The securities it holds account for 55% of its total assets, which is the highest among all banks in the United States. Do you know who the second one is? It is the other collapsed bank, Silvergate. When interest rates were low before, its risk was not so high. Although not hedging is not good, it can be understood. After all, the central bank is releasing a lot of liquidity, and hedging is actually quite expensive. But in 2022, when liquidity deteriorated rapidly, the risk also rapidly increased. If you still do not hedge and stop losses, and rely on the market to recover by itself, this problem is very serious. There is a gambling element in this. So, as you can see, finance ultimately comes down to human nature. Greed and the desire for good luck play a big role in it. This was actually one of the most important lessons I learned while working at JPMorgan. When daily fluctuations are so great, and there's a particularly large loss, an employee might be tempted to hold on to it, hoping to make up for it later. However, once management becomes involved, the outcome is almost certain. The loss will be hedged or the position will be closed out immediately. This can be difficult to accept, as it goes against human nature. Risk management in banking is also somewhat counterintuitive. When the market is doing well, risk managers are there to keep everyone from making too much money and to control risk. However, when the market crashes, it's the risk managers who are blamed for not doing enough. The Chief Risk Officer, CRO, at Silicon Valley Bank left in April 2022, during the worst half year of losses. This meant that the bank was without a risk manager during a time when it needed it the most. The second big reason for Silicon Valley Bank's collapse was the rapid interest rate hikes by the Federal Reserve. We've already analyzed this, so there's not much more to say. Another issue with Silicon Valley Bank was that its clients were too concentrated in the startup community. This is a small problem in the grand scheme of things. Small and medium-sized banks have to target a small group of people or a specific area. Silicon Valley Bank and Silvergate Bank both grew quickly because they focused on a small group of clients. The herd mentality among Silicon Valley entrepreneurs also played a role in the bank's collapse. When the big names in Silicon Valley heard rumors, they would call for everyone to withdraw their money. This panic caused the bank to fail, even if it hadn't already lost over $10 billion. Banks try to prevent the market from knowing when they have problems, but this can sometimes backfire and create even more fear and panic. Interestingly, Silicon Valley Bank's CEO was previously the CFO of Lehman Brothers' fixed income division. Will this turn into a large-scale financial crisis like in 2008? My answer is that it's possible, but the probability is low. In 2008, it was the investment banks that caused the problem. They were much more reckless and leveraged, and had distorted the entire market. This time, it's just one bank that invested and lost money, and it didn't really distort the market. The overall environment is also different. In 2008, the economy was overheated, like a car that was driving too fast and about to catch fire. This time, it's like a car that brakes too hard, and Silicon Valley Bank was thrown out of the front window. When Lehman Brothers collapsed in 2008, it affected the entire Wall Street, including investment banks, hedge funds, insurance companies, and asset management companies. Silicon Valley Bank mainly bought MBS and was mainly associated with depositors. When the government bailed out Lehman Brothers, it had a strong moral pressure to do so. However, this time the government can calmly say that it will save depositors, but not the bank. So, everything is quite different. When we compare Silicon Valley Bank and Lehman Brothers, we can see that this doesn't seem as serious. However, we just talked about a simple comparison, and there are still credit crises for many small and medium-sized banks, which could lead to a financial crisis in a tight liquidity environment. The government is now trying to stabilize the situation and reassure everyone that everything is okay. Based on current conditions, it should be controllable. But the market sentiment is like a string that is stretched tightly, and it could break if stretched too far. If something else happens, like a large company experiencing financial difficulties or the stock or real estate markets collapsing, and the panic sentiment spreads, then it could be very troublesome. As we learned from Ben Katz's video, if the market panic spreads, it could be very scary. However, I personally feel that this is still a low probability event. In normal circumstances, the market will slowly calm down, and the run on banks will gradually disappear. We can only wait and see how it will develop.